Welcome to Coin Flip. I'm Derek Wu, and today we are talking about the Federal Reserve, which, I know, sounds like the kind of topic that belongs in a college lecture nobody asked to attend. But stick with me, because this one actually affects your savings account right now. 3 things on the table today. First, we'll look at what the Fed actually decided and why the April vote was the most divided in over 30 years. Second, we'll talk about Warsh, who he is, what he said publicly, and what his hawkish track record probably means for the rate path ahead. That matters because markets are now pricing more questions than answers on cuts. And third, and this is the one I want you to pay attention to, high-yield savings accounts are currently paying up to 4.21% APY at online banks. NerdWallet's been tracking this. Meanwhile, the national average at big banks is still sitting near 0.01%. That gap is not a rounding error. On $10,000, we're talking about the difference between $400 a year and basically nothing. The boring answer here is usually the right one, and today the boring answer is move your idle cash. We'll walk through exactly how to think about that, including a clean framework for deciding whether a CD or a high-yield savings account makes more sense for your situation. We've got a lot of ground to cover. The Fed decision first. Let's start there.
Let's be honest. When the Federal Reserve holds rates steady, most people's eyes glaze over. The Fed did nothing. Cool, moving on. But here's the thing. Sometimes nothing happening is actually the whole story. According to Wells Fargo Investment Institute, the FOMC held the federal funds rate at 3.50 to 3.75% on June 17th. That's 3 holds in a row for 2026. And the Fed's own language flagged that job gains have remained low while inflation is still elevated. So what does that mean in plain English? The Fed looked at the economy and said, we're not cutting, we're not hiking, we're watching. Now, to put this in perspective, for savers, that's actually good news. High-yield savings accounts and money market funds are still paying real rates. The Fed's own April minutes show the reserve balance rate sitting at 3.65%. That's not nothing. That's money working for you while you sleep. The boring answer, park cash somewhere that pays you while this plays out. Good enough beats perfect every time. But here's where it gets interesting and why this hold is different from the last 2. CNBC reported the Senate confirmed Kevin Warsh as the new Fed chair on May 13th in a 54-45 vote, the closest confirmation in the modern era. He was sworn in May 22nd. That means June 17th was his very first meeting running the room. Now, to put this in perspective, Warsh is not Powell. He's been openly critical of the Fed's post-2008 balance sheet expansion. Markets have already started repricing the rate path, not toward cuts, but toward holding or even hiking. So you've got a new chair, sticky inflation, and a committee that's increasingly divided. The April FOMC minutes noted that several participants wanted to drop language suggesting an easing bias entirely. The important thing to understand is the hold itself was predictable. What comes next isn't, which raises the question, who exactly is Kevin Warsh? What does he actually believe, and does any of it change what you should be doing with your money right now?
So let's talk about what this leadership change actually means, because it's not just a new name on the door. Warsh was confirmed 54-45 by the Senate, the closest Fed chair vote in modern era. And Powell? He's still in the building, still on the Board of Governors through 2028. CNBC noted that's the first time a former chair has returned to the board in nearly 80 years. Think about that dynamic. The guy who held rates steady for 3 years is now sitting across the table from the guy who was brought in to shake things up. Same players, different coach. And here's what Warsh actually walks into. Inflation running at 4.2% year over year as of May. That's a 3-year high. Strong labor market. May payrolls came in at 172,000 jobs. The Fed's own April minutes showed options markets were pricing about a 30% probability of a hike by early 2027, even before Warsh took the seat. CBS News reported one economist put it plainly, Warsh will have a hard time convincing anyone to cut rates anytime soon, and that was written before his first meeting. So the guy who was supposed to bring rates down might end up raising them. That's the situation.
Polymarket prediction markets currently put the odds of a rate hike in 2026 at around 38%. Rate cuts, basically zero. The consensus among economists in recent Reuters polling is hold through year-end at 3.50 to 3.75%. What does that mean practically? The higher-for-longer environment we're in right now is not going away in the next few months, but it's also not permanent. Warsh's first few meetings will be the signal. If the inflation data starts cooling, the conversation shifts fast. The important thing to understand is this. You have a window right now where rates are meaningfully high. The question is whether you're actually using it, and that's exactly where savers come in.
So here's the window savers are sitting in right now. While Warsh figures out his first move, your savings account should be doing some work. The math is embarrassingly simple. $10,000 parked at a big national bank, Chase, Bank of America, U.S. Bank, earns roughly $1 a year. $1 at 0.01% APY. Move that same $10,000 to a high-yield savings account at an online bank. NerdWallet has accounts paying 4.01% APY as of this week. That's $400 a year. Same money, zero risk, just a different account. Now, Fortune has been tracking rates daily, and the top accounts are running up to 4.21% APY right now. The gap between a traditional bank and a high-yield account isn't close. It isn't a debate. It's $1 versus 400. Here's the one risk worth knowing. According to NerdWallet, high-yield savings rates have been drifting down over the past few months. Those late 2025 rate cuts from the Fed pulled them lower. And if banks start pricing in even a single cut on the horizon, rates move before the Fed does. The window doesn't announce itself when it closes. So yes, opening a new account is mildly annoying. You'll fill out a form, move some money, wait a couple of days, 10 minutes, maybe 15, and then it just runs. This is not a coin flip. Most of what we talk about on this show is genuinely uncertain. This is not one of those things. If your emergency fund is sitting in a traditional savings account right now, that is the first move, full stop. Good enough beats perfect here. You don't need the single highest rate account on the list. You need one that's FDIC insured, no monthly fees, and paying north of 4%. Open it this week. Okay, you've got the savings sorted. Now comes the actual decision. Because once the cash is earning, the next question is whether some of it should be locked in. And that's where CDs enter the picture.
So the follow-up question is sitting right there. For money you won't touch, a 12-month CD is worth a hard look right now. Let's think about this. Top CD rates at online banks are sitting around 4.10% to 4.25% APY right now, according to Bankrate and Fortune. That's slightly above what most high-yield savings accounts are paying. The trade-off, you hand over your liquidity. And here's why that trade might actually make sense. The Fed held rates steady, third straight time in 2026, but nobody knows how long that lasts. A CD locks in today's rate for the full term. A high-yield savings account rate can move anytime a bank decides to move it. NerdWallet flagged that since early May, 7 accounts on their tracked list already lowered their APY. 2 went up, 7 came down. The window isn't permanent. So here's the two-question filter. Do you have a separate emergency fund already sitting somewhere? Second question, is this money you genuinely won't need for 12 to 24 months? If you answered yes to both, a 12 or 18-month CD deserves a hard look. If you said no to either one, stay liquid. Keep it in the high-yield savings account and don't overcomplicate it. The important thing to understand is the penalty math. Pull out of a CD early and you're handing back a chunk of that interest. So the only way this works is if you're actually confident you won't need the cash. To put this in perspective, we're not choosing between a good option and a bad one. Both are genuinely solid right now. CDs give you rate certainty. High-yield savings gives you flexibility. The question is, which one fits your actual situation? 2 questions. Emergency fund in place. Money you won't need for a year. Yes and yes, lock it in. Anything else, stay liquid. Good enough beats perfect every time.
All right, that's a wrap on this one. Here's what I want you to walk away with. The Fed held again, 3rd time in a row, and the instinct is to tune that out. Don't. Because the real story isn't the hold itself,
It's the window it's keeping open for savers. High-yield savings accounts at online banks are sitting at up to 4.21% APY right now. NerdWallet's been tracking this. Your big national bank is probably paying 0.01%. That gap is the whole point. $10,000 in the wrong account earns you $1 a year. In the right one, it earns you $400. That's not a rounding error. That's a decision. And the leadership piece. Kevin Warsh officially took over as Fed chair on May 22nd. His first meeting was June 17th. New coach, same players. What he signals about the rate path from here is what the next few months turn on. According to Indexbox's preview of that June meeting, the real question wasn't whether rates moved, and nobody expected that. It was whether the committee's language shifted away from an easing bias. That's the tell. A single sentence in a policy statement can reprice a lot. If you're holding cash in a checking account waiting for things to settle down, they're not going to. This is the environment. Park it somewhere that pays you while you wait. The two-question framework we walked through. Is your emergency fund covered, and can you leave this money untouched for 12 to 24 months? Yes to both. A short-term CD makes sense at today's rates. If not, stay liquid. That's the call. Make it. Good enough beats perfect every time, especially when perfect just means you kept your money in a savings account paying essentially nothing. Thanks for spending time on this with me today. If the episode helped clarify even one decision, that's the whole point of CoinFlip. Subscribe wherever you listen so you don't miss what comes out of Warsh's first press conference. That one's going to be worth paying attention to. And if you've got a money decision you're stuck on, drop it in the reviews. I might just flip a coin on it next week. I'm Derek Wu. Make the call. Talk soon.